Intermediate Accounting, Chapter 11, Depreciation, Impairment, and Disposition. Chapter 11, Depreciation, Impairment, and Disposition, 1 of 3. After studying this chapter, you should be able to 1. Understand the importance of depreciation, impairment, and disposition from a business perspective. 2. Explain the concept of depreciation and identify the factors to consider when determining depreciation charges. 3. Identify how depreciation methods are selected, calculate and recognize depreciation using straight line, diminishing balance activity, and other methods. 4. Explain the accounting issues for depletion of mineral resources. 5. Explain and apply the accounting procedures for partial periods and a change in depreciation rate. Chapter 11, Depreciation, Impairment, and Disposition, 2 of 3. 6. Explain the issues and apply the accounting standards for capital asset impairment under both IFRS and ASPE. 7. Account for derecognition of property, plant, and equipment, and explain and apply the accounting standards for long-lived assets that are held for sale. 8. Describe the types of disclosures required for property, plant, and equipment, and provide an analysis of investment in capital assets. 9. Identify differences in accounting between IFRS and ASPE, and what changes are expected in the near future. Chapter 11, Depreciation, Impairment, and Disposition, 3 of 3. Depreciation, Impairment, and Disposition. The importance of depreciation, impairment, and disposition from a business perspective. Depreciation, a method of allocation. Factors considered in the depreciation process. Depreciation, methods of allocation and calculation. Depletion of mineral resources, other depreciation issues. Impairment, indicators of impairment, impairment, recognition and measurement models, asset groups and cash generating units, held for sale and derecognition, long-lived assets to be disposed of by sale and derecognition, presentation, disclosure, and analysis, presentation and disclosure, analysis. IFRS-ASPE comparison, a comparison of IFRS and ASPE looking ahead. The importance of depreciation, impairment, and disposition from a business perspective. Depreciation is a method of matching the cost of property, plant, and equipment to the economic benefits derived as the asset's capacity and output are used up over multiple periods. It is a way to link the costs and benefits of the assets to the revenues that they help generate in the period in which they are generated. If property, plant, and equipment is not depreciated, businesses might need to record large losses in the year of disposition. Depreciation helps businesses ensure that assets are carried at an amount no higher than what is expected to be recoverable for the asset, although it is not a method of valuation. Many of the factors included in calculating depreciation rely on estimates. Companies need to regularly assess for impairment. Depreciation, 1 of 2. Depreciation, 1 of 2. Is the process of allocating the carrying amount of a property, plant, and equipment asset to expense in a systematic manner to those periods expected to benefit from its use. It is not a matter of valuation. It is an estimate. It is less difficult and more cost-effective than measuring the changes in asset values every reporting period. Depreciation is reserved for property, plant, and equipment under the umbrella of amortization. And amortization is the general process of cost allocation and the specific name for the process for intangible assets. Depletion is used for natural resource assets. It is not a method of determining an asset's declining value. Depreciation 2 of 2. Questions to be answered to determine the amount of depreciation expense. What? 1. What asset components are depreciated separately? 2. What is the asset's depreciable amount? 3. Over what period is the asset depreciated? 4. What pattern best reflects how the asset's economic benefits are used up? Judgment and estimates are needed to answer these questions. Depreciation asset components. Each significant part of a property, plant, and equipment asset should be identified and depreciated as a separate component. Multiple components may be grouped for calculating depreciation if they have the same useful lives and depreciation methods. Parts of each property, plant, and equipment asset that are not individually significant can be grouped and depreciated as a single component. Application of components for the purpose of depreciation is required by both ASPE and IFRS. However, IFRS is more detailed and strict. Depreciation, depreciable amount. Depreciable amount is the difference between the original cost of the asset and the estimated residual value. Residual value is the net amount expected to be received for the asset today if it were the same age and in the condition expected at the end of its useful life. Residual value should be reviewed regularly, at least annually under IFRS. Depreciation continues as long as residual value is lower than asset's carrying amount. Under ASPE, the depreciation charge is the higher of the cost less salvage value over the life of the asset and cost less residual value over the asset's useful life. Salvage value is the asset's estimated net realizable value at the end of the asset's life, and it's not used under IFRS. Depreciation period. Depreciation begins when the asset is available for use. Depreciation ends when the asset is derecognized or classified as held for sale. Depreciation continues even if the asset is idle or has been taken out of service unless it is fully depreciated. An asset's useful life and physical life are not the same, expressed in time or units. Useful life is sometimes referred to as the economic life, the period of time over which the asset will produce revenue for the company. Factors affecting useful life are economic factors, such as obsolescence, physical factors, like wear and tear, and legal life, expiration of contracts. Depreciation, choice of depreciation method. Method should amortize an asset in a pattern and at a rate that corresponds to the benefits received from the asset. Often involves the use of professional judgment. Additional considerations for choosing a particular depreciation method include simplicity, tax reporting, for example, CRA method to avoid duplication, cost benefit, impact on ratios, as well as perceived economic consequences. IAS 16, depreciation methods based on revenue not allowed. Depreciation method affects the statement of financial position, the income statement, and ratios, for example, return on assets, etc. Depreciation straight line method. Under the straight line method, depreciation is considered a function of the passage of time. Most widely used method in practice because it's straightforward, easy to understand, often the most conceptually appropriate method. Disadvantages. Assumption that the asset actually does deliver equal economic benefits each year. It may violate the matching principle. Assumption that the maintenance expense is about the same each period. May violate the matching principle. Results in an increasing rate of return because the book value decreases. It's the cost less residual value divided by the estimated useful life. Depreciation diminishing balance method. Creates a higher depreciation expense in the earlier years and lower charges in the later periods. It's based on the assumption that many assets offer their greatest benefits in the early years. Repair and maintenance costs are often higher in later periods. Version used in Canada is the declining balance method. The rate percent, calculated as a multiple of the straight line rate, applies the appropriate rate to the asset's carrying amount at the beginning of each period. Depreciation stops when carrying amount reaches residual value. Net book value times constant rate of depreciation. Depreciation activity method calculates depreciation according to usage or productivity instead of the passage of time. Best measure of periodic expense: low depreciation with low usage, high charge with high usage, no charge when idle. Assets life defined in terms of output, units produced, or input, number of operating hours. Limitations: not appropriate when assets life is affected by economic or functional factors that are unrelated to usage. Appropriate for only a few situations, mostly extractive industries referred to as depletion. Difficult to estimate units for life of the asset. It's cost less residual value divided by total estimated units equals the dollar amount per unit. Depreciation methods example. Crane Ltd. buys a crane at the beginning of the current fiscal year. Information relating to the crane follows. Cost, $500,000. Estimated useful life, 5 years or 30,000 hours. Residual value, end of 5 years of use, 50,000. Actual hours used during the current year, 4,000 hours, and assumed 4,700 in next year. Based on this information, calculate the amortization for the current year using straight line, diminishing balance, and activity methods. Straight line method example. Depreciable amount. 500,000 minus 50,000 equals 450,000. 2. Annual depreciation. 450,000 divided by 5 years equals 90,000. 3. Depreciation schedule. Year 1, book value is 500,000, depreciation expense is 90,000, accumulated depreciation is 90,000, and book value at the end of the year is 410,000. Year 2, book value is 410,000, the depreciation expense is 90,000, the accumulated depreciation is 180,000, and the book value at the end of the year is 320,000. Note that the depreciation expense is the same each year. Diminishing balance method, double declining balance method example. Rate of depreciation equals 2 times 1 divided by 5, which equals 40%. The rate equals 100% divided by useful life in years times 2. Depreciation current equals 500,000 times 40% equals 200,000. Depreciation next equals 500,000 minus 200,000, and then multiply that by 40%, which equals 120,000. The asset's residual value is not deducted. And the depreciation schedule from years 1 to 5 is the book value, 500,000, depreciation expense, 200,000, accumulated depreciation, 200,000, book value end of year, 300,000. That book value end of year becomes book value at the beginning of the next year for 300,000. And then you apply the depreciation rate to get 120,000. Accumulated depreciation is now the 120 plus the 200,000 from the previous year to make 320,000. And then the book value at the end of the year is the 180,000. And so on up until year 5. Last year is rounded. Book value cannot be less than the residual value. Activity method example, unit equals hour. 1. Depreciable amount equals 500,000 minus 50,000 equals 450,000. 2. Depreciation per hour equals 450,000 divided by an estimated 30,000 hours equals $15 per hour. This same rate is used each year. The depreciation in the current year equals $15 times 4,000 hours, which equals 60,000. And then the depreciation in the next year equals $15 times 4,700 hours equals 70,500. So in year one, you have a book value of 500,000, depreciation expense of 60,000, accumulated depreciation expense of 60,000, and the book value at the end of the year is 440,000. In year two, the book value is 440,000 at the beginning. The depreciation expense is 70,500. The accumulated depreciation to date is 130,500, and the book value at the end of the year is 369,500. Depletion of mineral resources. Costs of acquisition, exploration, and development, including asset retirement costs, are capitalized. Costs allocated to natural resources as they are extracted. Depletion is calculated using an activity method such as units of production. The biggest challenge is uncertainty over resource quantities. Depletion charge is initially debited to inventory or product cost. When the resource is sold, inventory is credited and cost of goods sold is debited. Where an equipment's useful life is clearly linked to the life of the resource, it is also amortized using the units of production method. Depletion example 1 of 2. Assume a company acquired the right to use 1,000 hectares of land in the Northwest Territories to mine for gold. Costs for the mine include lease, 500,000, exploration and evaluation, 1 million, and development, 38.5 million. So the total capitalized cost is 40 million. The company estimates the mine will provide approximately 50,000 ounces of gold, and there is no residual value. A. Calculate the depletion rate and provide the journal entry to record depletion, assuming that 12,500 ounces are extracted in the first year. B. Show how depletion would be presented in the company's financial statements. Depletion example 2 of 2. Calculate the depletion rate. Total cost minus residual value divided by total estimated units available equals depletion cost per unit. So that's 4 million divided by 5,000 ounces. That equals $800 per ounce. Calculate depletion charge for the year. 12,500 times 800 per ounce equals 10 million. Entry to record depletion. Debit inventory, 10 million. Credit accumulated depletion, 10 million. And on the statement of presentation, you have the gold mine at cost, 40,000, less accumulated depletion of 10 million to give you 30 million. Liquidating dividends. Distribute to shareholders a portion or all of their capital investment, typically equal to the accumulated net income after depletion plus the amount of depletion that has been charged. Biggest issue is determining which dividends represent a return on investment and which are a return of capital. The procedure is deduct retained earnings from the total dividend. Balance is deemed a return of capital. Liquidating dividends example. Assume Callahan Mining Corp. Has a retained earnings balance of 1.65 million, accumulated depletion on mineral properties of 2.1 million, and common share capital of 5.4 million. Callahan's board declares and pays a dividend of $3 per share on the 1 million shares outstanding. So the dividend paid is 3 million, the balance in retained earnings is 1.65 million, and the liquidating dividend is 1.35 million. The $3 per share dividend consists of a $1.65 per share return on investment and a $1.35 per share liquidating dividend or return of capital. Other depreciation issues, partial periods. When an asset is acquired, sometime during the year, a partial depreciation charge is sometimes taken. Various approaches, for example, no charge for first year, full charge for last year, is allowed as long as there is consistency and it is immaterial. The procedure is determine depreciation for a full year and allocate the amount to the partial period. Partial periods examples. Assume a drill machine was purchased for $45,000 on June 1st, 2020, with a 5-year life and no residual value. So straight line amortization would be $45,000 divided by 5 years, and that will give you the yearly straight line amount, and then you would multiply that by 7 out of 12 months. So that's January, February, March, April, May, June. So that's your first 6 months. And so then from June, July, August, September, October, November, December, that's the amount that you're depreciating, the 7 months. So that gives you $52.50. So we just go to the nearest full month. Then with double declining balance rate, you would do your 100% divided by 5, multiply that by 2, and that gives you 40%. So in the first year, you're going to do that partial month again, the 7 out of 12 months. So when you're determining the depreciation charge, you're going to take the $45,000, which is the full year, times 40%, and then you multiply that by 7 out of 12 months just to get the depreciation for that last 7 months, and that's $10,500. And then the new carrying amount will be the $45,000 minus the $10,500, and it will be $34,500. And then you do that until the end of year 5, and then in year 5, you're going to recognize the remainder, which is 5 out of 12. With declining balance, it could take many years to reduce carrying value to 0. Activity. Not applicable as method is not based on time. Other depreciation issues, revision of depreciation rates, 1 of 2. Determination of depreciation involves estimates of useful life, residual value, and expected pattern in which asset benefits will be received. These estimates need to be reviewed regularly under IFRS at least at the end of every fiscal year end. When a change takes place, companies are not permitted to go back and change previous year's records or to make a catch-up adjustment for any accumulated differences. The changes do not affect prior periods. Other depreciation issues, revision of depreciation rates, 2 of 2. The revised depreciation is applied prospectively to the remaining life of the asset. For example, it is accounted for in the period of the change and in future periods. New depreciation is calculated based on the undepreciated cost remaining, along with the most recent estimates of residual value and remaining useful life. For the declining balance method, a change in the estimated life would result in a new depreciation rate applied to the current book value. If another depreciation method is considered more appropriate, it will be applied going forward. Revision of depreciation estimates, example, 1 of 2. Depreciable asset purchased for $90,000. Estimated life was 20 years. Estimated residual value was $10,000. Pattern of benefits received, equal amounts per period. In year 9, estimates were revised as follows. Estimated life, total of 30 years. Estimated residual value, $2,000. Determine amortization for 9th year based on the straight line method of depreciation. Revision of depreciation estimates, example 2 of 2. Book value of the asset at the date of the revision of estimates. So you take $90,000 minus $10,000 divided by 20 years. So that's $4,000 per year, straight line amortization. 4,000 times 8 years equals 32,000 of accumulated depreciation. So the book value now is 90,000 minus 32,000 equals 58,000. The revised amount of depreciation per year, 9th to 30 year, equals 22 years remaining. So you take the 58,000 minus the 2,000, divide that by 22 years, and that gives you amortization or depreciation of $25.45 each year now. Impairment, indicators of impairment. Depreciation does not provide valuation of an asset. Property, plant, and equipment assets must still be checked for impairment. Impairment occurs when the carrying amount of a long-lived asset, such as property, plant, and equipment, is greater than its future economic benefit to the company. There are many external and internal indicators that provide evidence of possible impairment. So external could be significant change in technology, market, economic, or legal environments, increasing market rates, negative effect on recoverable amount or value in use, market capitalization exceeds carrying value of net assets, internal, obsolescence or physical damage, significant changes in how the asset is used, reports that performance has worsened, for example, increased downtime. Impairment, recognition and measurement models. Management needs to regularly evaluate assets for indicators of impairment. IFRS requires this at the end of each reporting period, but ASPE allows waiting until there is indication that the carrying amount may not be recoverable, a trigger. If there is an indication of possible impairment, then the asset must be tested for impairment. Two main approaches to measuring impairment losses are ASPE, the cost recovery impairment model, and IFRS is the rational entity impairment model. Impairment, cost recovery model 1 of 2. Under this model, an asset is impaired only if carrying amount cannot be recovered from using and eventually disposing of the asset. There's a recoverability test, i.e., impaired if the carrying amount is greater than undiscounted future net cash flows. Assumes the asset will continue to be used. Impairment loss is the difference between the carrying amount and its fair value. Under this model, fair value is the price that would be established in a non-arm's length transaction between knowledgeable, willing parties and measured in an active market. Impairment cost recovery model 2 of 2. Impairment losses are recognized as expenses charged to loss on impairment account. Offsetting credit can be the accumulated impairment losses, accumulated depreciation, or the asset capital account. Impairment losses cannot be reversed. After loss is recorded, depreciation method, remaining useful life, and residual value should be reviewed. This is used under ASPE. Impairment cost recovery model example. An asset's carrying amount is $600,000. That's $800,000 cost less $200,000 accumulated depreciation. Fair value is $525,000. A. Expected future cash flow is $650,000. The recoverability test is the carrying amount is $600,000. The future cash flows are $650,000, and that's a decrease of $50,000. No impairment. Future cash flows are greater than the carrying amount. B. Expected future cash flow is $580,000. So the carrying amount is $600,000 and the future cash flows are $580,000, and that gives you a difference of $20,000. So in this case, it is impaired because the carrying amount is greater than the future cash flows. Impairment loss. The carrying amount of $600,000 and the fair value of $525,000 gives you a difference of $75,000. Impairment, rational entity model 1 of 2. This approach assumes an entity makes rational decisions in managing its long-term assets. If management can't earn a higher return from using an asset, value in use, then the company will continue to use it. If management can earn a higher return from selling the asset, then the rational decision is to sell it, fair value less cost of disposal. An impairment loss is determined by comparing the asset's carrying amount and recoverable amount, greater of the value in use and the fair value less cost of disposal. If carrying amount is greater than the recoverable amount, then impairment loss is difference between the two values. This is used under IFRS. So impairment rational entity model 2 of 2, value in use, is the present value of the future cash flows expected to be derived from the asset's use and subsequent disposal. Fair value less cost of disposal is the amount currently expected to be received from the sale of the asset in an ordinary transaction between market participants after subtracting incremental costs directly related to the sale or disposal. Under the rational entity method, the credit for impairment losses must be recorded separately in an accumulated impairment losses account because the loss may be reversed in the future. Reversal limited to the amount of losses previously recorded. Advantages over cost recovery model. It captures both declines and inclines in value. It considers time value of money, and it considers the fair value of the impaired assets. Impairment rational entity model example. The carrying amount is $45,000. It's $60,000 cost minus $15,000 accumulated depreciation. The value in use is $37,500, and the fair value less cost of disposal is $40,000. The recoverable amount is $40,000. The higher value in use of $37,500 and fair value less cost of disposal $40,000. Impairment loss is the carrying amount $45,000 and the recoverable amount of $40,000 for the difference of $5,000. Asset groups and cash generating units, CGU. Many assets do not generate cash flows independently, so impairment analysis cannot be done at the level of the individual asset. These assets are identified within an asset group or cash generating unit, CGU, i.e., smallest identifiable group of assets that generates cash inflows that are predominantly independent of the cash flows from other individual assets or other group of assets, IAS 36.68. Both cost recovery and the rational entity impairment models are then applied to the groups of assets instead of the individual asset. Any impairment losses are then allocated to individual assets proportionally based on relative carrying costs. No individual asset can be reduced below its fair value under cost recovery model or recoverable amount under rational entity model if these amounts are known. Long-lived assets to be disposed of by sale. A long-lived asset is classified as held for sale if the company intends on disposing of the asset by sale within a short period of time and meets other strict criteria described in Chapter 4. Held for sale assets are reported separately on the Statement of Financial Position, not depreciated while they are held, carried at the lower of carrying amount and fair value less cost of disposal. Losses are recognized. Subsequent increases in net realizable value must be recognized as gains, but only to the extent they offset previously recognized losses. ASPE allows classification as current assets only if sold before financial statements are complete. Derecognition, sale of property, plant, and equipment. Plant assets may be retired voluntarily or disposed of by sale, exchange, involuntary conversion, or donation. Depreciation is recorded up to the date of disposal. A gain or loss is usually recognized. Gains or losses on derecognition are reported in income. If an asset is abandoned, Abandoned, then the loss equals the asset's book value. If an asset is sold for scrap, gain or loss equals the difference between the scrap value and the book value. Disposal of an asset held for use example. A machine costing $18,000 has been used for 9 years. Depreciation was $1,200 per year. The machine is sold in the middle of the 10th year. So you would record depreciation expense $600, credit accumulated depreciation machinery $600. This brings the depreciation up to date. Then you would debit cash for $7,000, debit accumulated depreciation machinery $11,400. So that's the accumulated depreciation total to remove it from your books. Then you're going to credit machinery for $18,000 to remove that from your books. And then you're left with a credit of $400,000 to balance out your journal entry. So then that would be a credit gain on disposal of machinery for $400. Disposal of an asset in voluntary conversion example. The company receives $500,000 for expropriated land and building. The current book value of the building is $160,000, which is a $300,000 cost minus $140,000 accumulated depreciation. The book value of the land is $100,000. So you're going to record a debit to cash for $500,000, that's the proceeds. You'll debit accumulated depreciation building for $140,000 to remove the accumulated depreciation from the books. You would credit building for $300,000 and credit land for $100,000 to remove those assets from the books. Then you're left with a credit of $240,000 to balance out your journal entry, and you would record that as a gain on disposal of land and building. Disposal of an asset, donation of capital assets example. So a company donates property with a fair value of $120,000, land carried at $30,000 fair value, and building carried at a cost, $95,000 less accumulated depreciation $45,000. So you debit contribution expense $120,000. The donation is recognized as an expense. You would debit accumulated depreciation building for $45,000, credit building for $95,000, and credit land for $30,000. And these removes those assets from your books. And then you're ending with a credit of $40,000. So you would put that to the gain on disposal of land and building. Presentation and disclosure. There are many significant disclosures required for property, plant, and equipment. Types of disclosures include the following: gross carrying amount, property, plant, and equipment, investments, biological assets, changes in gross carrying amount, accumulated depreciation, impairments, separation of cost and accumulated depreciation, nature and circumstances related to impairment losses and reversals, changes in assets due to fair value measurements, depreciation rate and methods, outstanding contingencies. Specific standards under IFRS generally have more extensive disclosure requirements compared to ASPE. Analysis of property, plant, and equipment. 1. Efficiency of asset use. Dollars of revenue produced by each dollar of invested assets. So the asset turnover equals net revenue divided by your average total assets. Profitability analysis. How much is left over from each sales dollar after all expenses are covered? That's the profit margin percentage equals net income divided by net revenues. Profitability of the investment in assets affect long-lived assets have on profitability. So the rate of return on assets is the net income divided by your average total assets. Rate of return on assets also just equals the asset turnover times the profit margin percentage. IFRS and ASPE. ASPE and IFRS are consistent in many areas of accounting for depreciation and disposition. Most significant difference between the two standards relates to the measurement of impairment losses. There are no major changes expected in this area. Looking ahead, in December 2017, the IASB met and discussed the introduction of management performance measures into the financial statements and where the measures should be located in terms of presentation and disclosure. Next steps being considered are a discussion paper or exposure draft related to the issue, together with some possible improvements to the statement of cash flows. The end.